As the UK infrastructure market continues to seek new sources of debt for funding major projects, Redington, an investment consultancy which advises pension funds and insurance companies, recently announced plans to develop a new debt infrastructure investment platform with support from law firm Pinsent Masons. TFI-News met with Redington's co-CEO, Rob Gardner, to discuss the new investment vehicle. First question up was to explain the role of Redington.
Redington is an investment consultancy. We advise large pension funds around the world. We are known for helping clients think about their assets and liabilities. And so the way we do that is we have what's known as a 7-step framework to help pension funds achieve their investment and funding goals. And the whole point of this is to leave them feeling in control of their asset and liability problem.
And you're currently working with Pinsent Masons on a platform to allow clients to invest in UK infrastructure debt. Can you give me an update on this and how it's being structured and the latest news on that?
It's probably worth just stepping back and sort of saying why UK infrastructure debt. So I mentioned in the intro this sort of 7-step framework, and a big part of that is defining the goals and objectives of a pension fund. And pension funds now need to find investments that potentially match their liabilities, but also give them a positive rate of return. And so that's part A. Part B is, as a result of the global financial crisis and changing banking regulation, there are a whole lot of assets that need to shift from being on bank balance sheets to being with long-term investors, such as pension funds and insurance companies. And people still need to borrow long-term finance. So there's an opportunity that exists right now for pension funds to A, buy secondary infrastructure debt from the banks, and B, step in to the shoes of the banks and provide new finance to infrastructure projects. But again, I'm specifically talking about the debt. The rationale is that you can lend to some of these projects at a senior secure basis, which means that you have security over the underlying infrastructure assets, which tends to mean the credit quality is a lot better. You can invest for a long period of time, typically 20-25 years. There's the opportunity to lend inflation linked, which is a big plus for many pension funds. And typically you're paid anywhere between 80 to 100 basis points over where publicly traded unsecured corporate debt trade. So there's an attractive risk return pickup. So it's actually, the driver is, here's an asset class that pension funds haven't had access to before because it's been dominated by bank finance. It has an attractive risk and return. So those are all the drivers of like, why are we here? So that's part one. Part two is, well, how do we implement that? And the challenge that UK pension funds have is that there are only a few large ones that can make a day one £300 million allocation. So Redington sat down with Pinsent Masons and said, well, how are we going to make this happen? And we decided that the best way to make it happen was a consortium of pension funds that had the same beliefs as the ones I've just outlined and wanted to access this asset class, but maybe could only commit £15 million, 25 to £50 million. And in order to make it happen, we need probably 250 million to sort of cross the Rubicon. So we sat down with Pinsent Masons and we brainstormed a framework which would allow multiple pension funds to come together and act with the power of a £300 million investment, but still give people individual flexibility. And again, we didn't want to set up a common investment fund. We wanted to keep the governance of this structure light. So Pinsent Masons have been fantastic in thinking through all of those things. Redington's goal has been A, identifying the opportunity as I laid it out, and then B, we went out and asked a whole load of fund managers and banks to come back to us with, what can they deliver and at what spreads and so forth. So we've been running live with that really since the end of September. We've been to speak very seriously to 15 pension funds. 9 are very interested, and 6 of them have taken them to their investment committees.
And in terms of timescale moving forward now, what's the next milestone?
The next milestone for us is to get a sort of an MOU, a sort of soft commitment from all the pension funds, from those investment committees, to say yes, we're interested. That can then be given to the fund manager, who can then who's in discussion with the bank that they're trying to buy from. And then ideally, unfortunately, Christmas is coming up, but after Christmas in Q1 of 2013, look to implement that first tranche. Now, it's important to note the way that Redington and Pinsent Masons have set this up is it's very scalable. So, we think that once we've done this, this will be our proof statement. This will be our Stockton to Darlington proof of concept. We think we'll have a lot of other people come and say, look, can we grow this? So we've already thought about how we can allow a Fund 2 and a Fund 3. And then we're also in discussions with a very credible manager to actually lend new money or actually refinancing of short-dated bank debt into longer-dated inflation-linked paper. And we've been starting that conversation in the background to immediately follow through the launch of this first fund.
And in terms of the investors you're talking to, are they all British or is there international interest as well?
So at the moment we've focused solely on UK pension funds, although interestingly both Redington and Pinsent Masons have been we've sort of had emails from interested investors from all over the world actually, and actually we've been approached by non-pension fund investors as well who say, look, this looks interesting, how can we get involved? So.
And how does your platform differ or complement the platform being put forward by the NAPF?
Well, the first thing to do is it complements the NAPF PPF platform. Why? Because it's encouraging pension funds to use their sort of huge pool of capital and the fact that they can make illiquid investments to invest in infrastructure. Where it's different is that we're sort of starting with something very specific and deliverable. So UK secondary infrastructure debt that is in the operational phase. So we're starting with something that's very specific that pension funds can go, yeah, I want to invest in that, and here's my sort of 25 million, 50 million order. The NAPF PPF platform has a much broader remit, and it could be equity, it could be debt, it could be secondary, it could be new, and so they've obviously approached it in a different way. The goals and the objectives of both are very similar, and ultimately it will be a good thing because it will create a world of pension fund capitalism where pension funds are providing capital for infrastructure, which is much needed in the UK.
Obviously, the pension funds and their risk profile, construction risk is a no-no. They walk away from that. Surely one model to pursue in the current environment, with government borrowing at an all-time century low, is if government can initiate new construction projects, fund the construction phase from government borrowings, when it's operational, then sell on their interests to the pension funds. Is that a route to go down?
Well, a couple of things. I think, the construction risk, it's just that pension funds aren't familiar with infrastructure. And so there's always a lot more comfort to invest in something that's been built and you can go and see it and you can look at it on Google Maps. Actually, in the real estate world, in the property world, many pension funds invest in both existing assets and also assets that are being constructed. So I think you will see in the next 18 to 24 months a lot less aversion to construction risk. But right here, right now, there is an aversion to that construction risk. I completely agree, both the UK government and actually banks still have an appetite to lend, but they prefer to lend for shorter, 2 years, 3 years, 5 years. They actually have all the people with the origination skills and that sort of project PFI skill set, infrastructure skill set to lend. What they don't have is the balance sheet or the risk appetite to lend for 20, 25 years. So there is a natural short-term role for the UK government and banks, and pension funds could be there to say, well, look, once this asset's been constructed and up and running, we'll buy it on what's called a forward purchase basis. And that happens in the real estate market. Our clients get approached by people who say, look, we're looking to build this hotel, we're looking to build this office block. When we've built it and when we've got tenants moved in, will you buy it off us? And as long as those things are delivered, then you agree what's called a forward purchase. And that model would work perfectly well for infrastructure as well.
And in terms of the secondary market for debt, we've seen in the last 24 months Bank of Ireland and RBS deleverage and sell their debt infrastructure portfolios onto other players in the market and new entrants. Are you aware of any other banks now actually looking and taking active steps to deleverage their portfolio and move their debt off their sheets?
I think that nearly all the banks are having a high level of scrutiny at their balance sheet, their liquidity, the impact of Basel III. The big question is, at what price are they prepared to sell? So nearly every bank that has these assets on their balance sheet would look to delever at the right price. But the key word is there is what the right price is. So banks like the Irish banks, like Bank of Ireland, have been more driven to just take the pain early and have sold. Some of the other banks probably took a view that actually they were able to get their funding in place and are trying to sort of continue running the risk. So we'll just have to see how that plays out, and as I say, when Basel III kicks in, it will affect different banks in different ways, and different banks will prioritise it in different ways. What I would highlight is that the Bank of Ireland transaction, actually one of the largest purchasers of their portfolio was the Danish pension funds, and actually not UK pension funds. So actually one of the reasons why Redington and Pinsent Masons sort of collaborated together was we wanted to provide a bit of leadership and make it happen such that UK pension funds could invest in it, because the logic for the Danish pension funds is even more compelling for the UK pension funds.
Rob, thank you very much. Thank you.
Thanks, Paul.